Hey everyone, and welcome back to the Profitable Mindset Podcast. I'm really excited for today's episode because we're going to be talking about a strategy that can truly, I think, change your financial life. It's dividend growth investing. And this is about so much more than just making a little extra cash here and there. This is about building a portfolio that pays you more each and every year. And it can help you outpace inflation and really build some serious lasting wealth. And to help us navigate this fascinating world, we have a true expert in the field, someone who has really seen firsthand how this magic of compounding can turn, small, consistent investments into something really remarkable.
Well, thanks. It's great to be here. Yeah, and dividend growth investing, it's really, as you said, it's more than just, picking a few stocks here and there. It's a whole different way of thinking about building wealth for the long term.
Absolutely. Now, a lot of our listeners are familiar with investing basics, but let's get specific here. When we talk about dividend growth investing, what exactly are we looking for? What sets this approach apart from just, regular investing?
Well, at its heart, dividend growth investing focuses on identifying companies that not only pay dividends, but consistently increase those payouts year after year. So we're not just chasing, the highest yield right now. It's about finding those companies that are financially solid. They're well managed, and they really demonstrate a commitment to sharing their profits with investors like us.
I think, a lot of people get caught up in that excitement of stock prices going up and down every day. But it sounds like what you're saying is that real sustainable wealth building comes from focusing on those consistent dividend increases.
Absolutely. With dividend growth investing, you're essentially partnering with businesses that are built to last. These are the companies that have weathered, different economic storms. They've navigated those changing markets, and yet they still manage to reward their shareholders with bigger and bigger dividend checks. And, that consistency is a powerful signal of strength and stability.
So it's not just about the size of that dividend check today. It's about that upward trend, that the company is committed to sharing its success with investors over the long term.
You got it. And here's where it gets really interesting, the snowball effect of compounding. When you reinvest those dividends, you're buying more shares, which then generate even more dividends. It's this virtuous cycle that accelerates your wealth accumulation, especially when those dividend payouts are, steadily increasing. Think of it like planting a tree. It takes time to grow, but with that consistent nurturing, it eventually bears more and more fruit each year.
I love that analogy. It really paints a clear picture.
Yeah.
But can you give us like a real world example just to help people grasp how powerful this compounding effect really can be?
Sure. Let's imagine someone invests $10,000 in a company that's committed to dividend growth investing. They've got a solid dividend yield and they consistently increase their payouts. Over 20 years, that initial investment could potentially triple just through the power of reinvesting those dividends. That's over $30,000 without having to put in any extra money out of pocket.
Wow, that's pretty incredible. Now, I know some people hear dividend investing and they immediately think of those super high yield stocks. But it sounds like you're saying there's a really crucial difference between chasing those yields and focusing on consistent dividend growth.
Absolutely. Chasing high yields can be tempting, but it's often a trap. Those sky-high dividends might not be sustainable. The company could be in a risky financial position, or they might have to cut those dividends down the road.
So how do we avoid that trap? What should we be looking for instead?
Dividend growth is a much better indicator of a company's long-term health and their commitment to their shareholders. Companies that consistently increase their dividends are demonstrating that they can generate profits in different market conditions. They're not just squeezing out every last penny. They're thinking about the future.
So it's not about the size of the dividend today. It's about the trajectory. Those companies that prioritize growing their dividends are signaling they're well-managed and committed to their investors.
Exactly. They tend to be leaders in their industries, possessing what we call durable competitive advantages. Think of, iconic brands like Coca-Cola or Johnson & Johnson. They have a long history of paying dividends and consistently raising those payouts. They're not just surviving, they're thriving. That's the kind of stability and growth potential we're looking for in dividend growth investing.
Yeah, I'm starting to see why this approach can be so powerful. But I know a lot of our listeners are probably like, okay, this sounds great, but how do I actually start? Where do we even begin? What are the key things we should be looking for when we're trying to select these, winning dividend stocks?
Well, there are a few key factors to consider. The first is a company's financial health. Are they consistently growing their earnings? Do they have a strong track record of free cash flow, meaning they have cash left over after covering expenses and investments? And importantly, how much debt do they have? We don't want to invest in a company that's drowning in debt.
So it's about looking beyond just the dividend itself and really digging into the company's financials, making sure they're fundamentally sound and capable of supporting those dividend payments.
Precisely. You're looking for companies that are built to last, with a solid foundation. Then, of course, you want to look at their dividend history. Have they been increasing their dividends year after year? Ideally, you want to see a consistent pattern of growth even during those, tough economic times.
Yeah.
This shows a commitment to rewarding shareholders no matter what's happening in the market.
So let's say a company has been raising its dividend for 10, 20, even 30 years. That's a pretty good sign that they're serious about sharing their success with investors, right?
Absolutely. It shows they're in it for the long haul. And this brings us to another crucial point: competitive advantage. You want to invest in businesses that have something special that sets them apart, something that allows them to stay profitable over the long term. This could be a strong brand, unique technology, or a dominant market position.
So it's like they've got a moat around their business, something that protects them from being easily disrupted or overtaken by competitors.
Exactly. A moat is a great way to think about it. Now, there's a term you might have heard in the dividend investing world: dividend aristocrats. These are companies in the S&P 500 index that have increased their dividends for at least 25 consecutive years.
Wow, 25 years straight. So these are like the Hall of Famers of dividend growth investing. Are they a good place to start for someone who's maybe new to this approach?
They're definitely a great starting point. They've proven their ability to navigate different economic conditions and consistently reward their shareholders. But remember, there are plenty of excellent dividend growth stocks outside of that exclusive dividend aristocrat list. The key is to do your research. Look for that consistent dividend growth history and make sure those companies have strong financials.
This is great information. I feel like we've covered so much already. We've got a solid understanding now of what dividend growth investing is, why it's such a powerful strategy, and some of the key things to look for when we're selecting those winning stocks. But I know there's a lot more to unpack, especially when it comes to actually building a portfolio. So let's continue our conversation.
So, we've talked about finding those great individual stocks, but how do you actually put together a well-rounded dividend growth portfolio? What does that process actually look like?
That's a great question. We found all these amazing companies, but obviously we can't just, put all our money in one stock. How do we build a portfolio that's really going to grow consistently over the long haul?
Well, just like with any investing strategy, diversification is key. You don't want to put all your eggs in one basket. In this case, that means not concentrating all your investments in one company or even one industry. You want to spread those investments across different sectors of the economy.
Right. So we're not just talking about buying a bunch of consumer staple stocks or focusing only on energy companies. It's about building a mix.
Exactly. Think about sectors like healthcare technology, financials, industrials, and yes, even consumer staples. Each sector has its own unique characteristics and its own cycle. By diversifying, you're essentially creating a portfolio that's more resilient to those inevitable economic ups and downs.
So if one sector is having a rough year, another sector might be performing well.
Yeah.
And that helps balance things out.
That's the idea. And don't forget about international diversification. Expanding your portfolio beyond your home country can open up new growth opportunities and expose you to different economic cycles. And that can really enhance your returns over time.
I think a lot of investors, especially when they're starting out, tend to just focus on, their own domestic markets. But it sounds like there's a whole world of dividend-paying companies out there that we might be overlooking.
There is. And with exchange-traded funds, or ETFs, it's easier than ever to invest in international markets. There are ETFs specifically designed to track dividend growth stocks across different countries and regions, making it simple to get that global exposure.
That sounds incredibly convenient. It's like having a one-stop shop for international dividend growth investing without having to become an expert in every single market.
Exactly. Now let's circle back to something we touched on earlier, the magic of compounding. We talked about reinvesting those dividends, but I want to really emphasize just how crucial this is to unlocking the full potential of dividend growth investing.
Yeah, I have a feeling some of our listeners might be tempted to, cash those dividend checks and spend them.
Yeah.
Especially if they need the income. But you're saying that reinvesting, at least for, a good portion of our investing journey, is where the real long-term gains are.
Absolutely. Every time you reinvest a dividend, you're buying more shares, which generate more dividends, which buy even more shares. It's this beautiful cycle that can lead to exponential growth over time, especially when those dividends are consistently increasing.
Can you paint a picture for us? Just how impactful can this compounding effect be over the long run?
Let's imagine two investors, both starting with $10,000. One investor decides to pocket those dividend checks while the other diligently reinvests them. After 30 years, assuming a reasonable dividend yield and a consistent growth rate, the investor who reinvested could end up with a portfolio worth over $75,000. The investor who took the cash might only have around $40,000.
That's a huge difference, and it all boils down to that consistent reinvestment. It really is like a secret weapon for building wealth over the long term.
It is. And here's the best part. It can be surprisingly effortless. With dividend reinvestment plans or DRIPs, you can automate the entire process. Those dividends are automatically reinvested into buying more shares. You don't have to lift a finger.
Now, I know we can't talk about investing without addressing those inevitable market downturns. They can be, a little unnerving to say the least. How does dividend growth investing hold up when the market takes a nosedive?
It's a natural concern. While no investment strategy is completely immune to market downturns, dividend growth investing has a built-in resilience. And here's why those dividend payments, they keep coming in even when stock prices are falling. It's like having a steady paycheck during a financial storm.
So it's not just about the potential for growth during the good times. It's about having that steady income stream during the tough times. Those dividends can really provide peace of mind when the market gets choppy.
Exactly. And here's something else to consider. Bear markets, as challenging as they are, also present great buying opportunities. When stock prices fall, dividend yields become even more attractive. So if you're reinvesting those dividends during a downturn, you're buying more shares at lower prices, supercharging that compounding effect when the market recovers.
It's like turning a challenge into an advantage. You're getting those dividends while you wait for the market to rebound. And you're buying more shares at a discount.
That's the mindset shift we want to encourage. Instead of fearing those downturns, we can view them as opportunities to build long-term wealth. Now let's talk about another important aspect of dividend growth investing taxes.
Ah, yes. Taxes, can't forget about those. How do they affect those dividend payments?
Well, in many countries, qualified dividends are taxed at a lower rate than ordinary income. And one of the most common mistakes is getting seduced by those excessively high yields. Remember, if a yield seems too good to be true, it probably is. Always focus on the sustainability of those payouts and the company's overall financial health. Don't just chase the biggest number.
So we're not just looking at that dividend yield in isolation. We're doing our due diligence, making sure the company can actually afford to keep paying those dividends well into the future.
Exactly. Another common mistake is overlooking the importance of consistent dividend growth. Don't get fixated on the current yield. Look at the long-term trend. Is the company consistently increasing its dividend payouts year after year? If not, it might be a sign that they're not as committed to sharing their success with investors over the long run.
So it's not about the size of the dividend today. It's about that steady upward trajectory over time.
Precisely. And here's another pitfall, neglecting diversification. We touched on this earlier, but it's worth repeating. Don't put all your eggs in one basket. Spread your investments across different sectors and consider international diversification.
So even if we find a company we absolutely love, we're not putting all our money into it. We're maintaining a balanced and diversified portfolio to weather those market storms.
Exactly. And finally, don't panic sell during market downturns. We talked about how dividend growth investing can actually provide stability during those times. Remember, those dividend payments keep coming in even when the market is down. Stay the course, focus on your long-term goals, and use those downturns as opportunities to buy more shares at lower prices.
It's all about having that long-term mindset, riding out those inevitable market fluctuations, and knowing that with dividend growth investing, you're building a portfolio that's designed to pay you even when the market isn't cooperating.
That's the heart of it. Now, I know we've covered a lot of ground today, but if I could leave our listeners with one key piece of advice, it's this. Dividend growth investing is a powerful strategy for building wealth over time. It can provide a steady income stream and the potential for significant capital appreciation, all while promoting a disciplined long-term approach to investing.
We've talked about the financial benefits, but it seems like there's a psychological aspect to dividend growth investing as well. Knowing that your portfolio is steadily generating income no matter what's happening in the market has to provide some peace of mind.
Absolutely. There's a certain calmness that comes with knowing you're partnering with solid businesses that are sharing their success with you. It helps you stay focused on the long game and not get caught up in the daily market noise.
I think that's so important, especially for those who might be new to investing or who tend to get anxious when the market takes a dip. Knowing that you're building a portfolio that's designed to pay you consistently can make a huge difference.
It's a mindset shift.
Yeah.
You're not just trying to time the market or chase those short-term gains. You're building a portfolio that's designed to generate wealth steadily and sustainably over time.
So as we wrap up our conversation today, what's the one key takeaway you'd like our listeners to walk away with when it comes to dividend growth investing?
If I had to distill it down to one essential message, it would be this: patience is key. Dividend growth investing is not a get-rich-quick scheme. It's a strategy for building lasting wealth over years and decades. It's about finding those financially sound dividend-paying companies, reinvesting those dividends, and letting the magic of compounding work its wonders.
It's a long game,
Mm-hmm.
but a game that can be incredibly rewarding for those who are willing to stay the course, stay disciplined, and let those dividends compound over time.
Exactly. The real power of dividend growth investing lies in its consistency and resilience. It's a strategy that can help you weather those market storms, outpace inflation, and build a portfolio that's designed to generate a growing stream of income for years to come.
This has been an incredibly insightful conversation. Thank you so much for sharing your expertise with us today. I know our listeners have learned a lot.
It's been my pleasure. And for those who want to dive deeper into this world, there are so many great resources available: online books, articles, even communities of like-minded investors who are always willing to share their knowledge.
That's a great reminder. Everyone's investment journey is unique. The key is to find a strategy that aligns with your goals, your risk tolerance, and your long-term vision. And remember, the more you learn about investing, the better equipped you'll be to make those informed decisions that can lead to greater financial freedom. Thanks again for joining us. And to our listeners, thank you for tuning in to the Profitable Mindset Podcast. We'll be back next week with another episode to help you on your journey to financial success. Until then, keep those dividends growing.
Yeah, it's finding that strategy that really resonates with you and fits your long-term goals. There are so many approaches to investing, but dividend growth investing just has this certain appeal, this sense of building something solid and reliable.
Yeah, I totally agree. It's about aligning your investments with your values. If you believe in, supporting those companies that are well managed, they're profitable, and they share their success with investors, then dividend growth investing can be a really powerful way to kind of put your money where your beliefs are. Absolutely. And, we've talked about the financial benefits of this strategy, that steady income stream, the potential for capital appreciation. But it seems like there's a real psychological benefit as well, wouldn't you say?
Definitely. There's just this inherent sense of peace of mind that comes from knowing that your portfolio is designed to generate, a consistent and growing income stream. Regardless of what's happening in the broader market, it allows you to really tune out that noise, focus on the long game, and not get caught up in those daily ups and downs.
I've heard from a lot of our listeners who feel just overwhelmed by all the information out there. They get anxious watching the market fluctuate, and it ends up paralyzing them from taking action. Do you think that dividend growth investing can help with that?
I think it can be a fantastic antidote to that kind of anxiety. It's about shifting your focus from, that short-term speculation to long-term value creation. When you're invested in companies that are consistently growing their dividends, you're essentially partnering with businesses that are built to last. You can sleep better at night knowing that your portfolio is working for you, even when the market is turbulent.
I love that. Partnering with businesses, it's not just about buying stocks, it's about becoming a part owner of these companies that you believe in.
Yeah.
And, as those companies grow and prosper, you share in that success.
Exactly. It's a win-win situation. And as those dividends keep coming in and getting reinvested, it creates this powerful sense of momentum. Your portfolio is building, your wealth is growing, and it's all happening in this steady, predictable way. And that can be incredibly empowering, especially for someone who might be new to investing or feeling uncertain about the future.
So if someone is listening to this and they're feeling inspired to explore dividend growth investing further, what would be your advice? What are some practical steps they can take to get started?
I'd say the first step is education. Take some time to learn, the fundamentals of dividend growth investing. There's some fantastic resources available: online books, articles, even podcasts like this one.
Yeah, and I know there are some incredible online communities and forums dedicated to dividend growth investing as well. It can be really helpful to connect with other investors, share ideas, and learn from their experiences.
Absolutely. Connecting with others can make the journey so much more enjoyable and a lot less intimidating. And once you have, a basic understanding of the principles, start researching companies. Look for businesses with a long track record of paying and growing dividends, a solid financial foundation, and a durable competitive advantage.
That's great advice. And I think it's important to remember that everyone's investment journey is unique. There's no one-size-fits-all approach. The key is to find what works for you, what aligns with your goals, your risk tolerance, and your time horizon.
Well said. And don't be afraid to start small. You don't need a huge amount of capital to get started with dividend growth investing. Even a small initial investment consistently made over time can grow into something truly significant, thanks to the power of compounding.
That's a really powerful message to leave our listeners with today.
Okay.
You don't have to be a financial expert or have a lot of money to start building wealth. With a little bit of knowledge, a long-term mindset, and a commitment to consistency, you can create a brighter financial future for yourself and your family.
Absolutely. The key is to take that first step, to start learning, start exploring, and start building that dividend-paying portfolio. The rewards, both financial and psychological, are well worth the effort.
Well, this has been such an inspiring conversation. Thank you so much for sharing your insights and your expertise with us today. I know our listeners are walking away with a newfound understanding of the power of dividend growth investing.
It's been my pleasure, and I'm always excited to share this approach to building wealth because I truly believe it can transform lives.
And to our listeners, thank you for tuning in to the Profitable Mindset Podcast. We're here to support you on your journey to financial freedom. Until next time, keep investing in yourself, keep learning, and keep those dividends growing.